Hi everyone, today we have the hidden dividend champion that's about to create millionaires. My hope is that you watch my channel not just to follow blindly, but to actually learn and better yourself. I'm not going to wait until the middle of this video to reveal what this ETF is. I'll tell you right up front. But I hope you're not just someone who hears the name and is buying it. I hope you watch the video and form your own ideas about this ETF. For me, it's absolutely transforming my income portfolio right now. I'll explain what this ETF is, how it works differently than almost everything else, where it fits in the 3-fund portfolio, and how to invest in it for 2025. This ETF is the Schwab U.S. Dividend Equity ETF. The ticker is SCHD. When they say dividend equity, they absolutely mean it. This ETF launched on October 20th, 2011, nearly 14 years of proven data. On average, the fund produces 12.30% yearly return since inception. It has a 2025 year-to-date return of 4.25%, 1-year return of 2.90%, 3-year average of 8.95% per year, and 5-year average of 11.77% per year. Currently trading at $27.32 and paying a 3.79% dividend yield. How to build generational wealth in 10 years with this dividend beast. Had you invested in this fund 5 years ago with $100,000 and each month put $1,000 in with an average return of 11.77% per year that it's had, plus reinvesting the 3.79% dividend yield, today it would be approximately $385,000. If you stopped investing and let it compound for 5 more years, you would be at over $780,000. That's 10 years of growth with only 5 years of active investing. By year 20, your annual dividend income alone could exceed $30,000. I hope this got your attention. And for those of you that actually take the time to learn why this ETF is doing what it's doing, you're going to be light years ahead of your friends very quickly. SCHD versus VOO. The income champion versus the market giant. So the Schwab U.S. Dividend Equity ETF, it's all about the idea of dividend quality and sustainability. It basically finds the absolute best, strongest, most dividend reliable companies within the entire U.S. market and created an ETF of approximately 100 top dividend quality companies. This is why when we look at the performance comparison of SCHD versus the S&P 500, you can see some fascinating defensive patterns. VOO, which tracks the S&P 500, has significantly outperformed SCHD in 2025. SCHD has a year-to-date return of 4.25%. At first glance, you might think VOO is crushing SCHD, but look at the defensive power during crashes. In 2018, VOO dropped approximately 4.4%, while SCHD dropped 5.56%. In 2022, VOO dropped 18.11%, while SCHD only dropped 3.23% while paying dividends. So while VOO holders lost 18%, SCHD holders lost less than zero after dividends. That's the power of quality dividend companies. SCHD versus QQQM, Stability Champion versus Growth Rocket. To further this point, we all know about QQQM. It's an excellent growth ETF tracking the NASDAQ 100. QQQM significantly outperforms SCHD during bull markets, but experiences much larger drawdowns during crashes. SCHD provides steady income that compounds over time, plus smaller drawdowns during bad years. While QQQM pays minimal dividends, SCHD provides 3.79% annual income regardless of market conditions. The secret sauce? SCHD's 4-factor selection genius. So what is dividend quality? If you understand this, you understand the secret weapon. SCHD tracks approximately 100 stocks in the Dow Jones U.S. Dividend 100 Index. This index doesn't just pick high-yielding stocks. That's dangerous yield trap territory. Instead, it uses sophisticated 4-factor screening based on fundamental strength. The methodology emphasizes companies that sustain and grow dividend payments consistently. The 4 pillars that create dividend champions. First, cash flow to total debt ratio measures if companies generate enough cash to pay debts and dividends. Second, return on equity measures profit efficiency from shareholders' invested capital. Third, dividend yield ensures meaningful current income without yield traps. Fourth, 5-year dividend growth rate. Companies must prove they grow dividends over time. The index selects approximately 100 stocks with the highest combined scores, creating a portfolio of dividend champions. inside SCHD's current holdings, September 2025. As of September 2025, the fund is diversified with no sector over 25%. Top sectors include consumer staples, healthcare, energy, and financials, recession-resistant areas. Looking at recent holdings, the fund includes fortress companies that people need regardless of economic conditions. Unlike growth ETFs concentrated in big tech, SCHD provides excellent sector diversification. The ETF rebalances quarterly and reconstitutes annually, automatically rotating into new dividend champions. With this selection process and 14-year track record, you'd expect high fees, but the expense ratio is only 0.06%, just $6 per $10,000 invested. The September 2025 income opportunity. Late 2025 is compelling for SCHD investors. The current 3.79% yield provides excellent value, and dividend growth compounds over time. That 3.79% yield today will likely grow to 5%, 6%, or higher yields on your original cost as companies increase payments. How to invest SCHD with lower risk but higher total returns. Now at this point, I'm sure you're thinking, well, if this fund pays me 3.79% in dividends, has proven itself through multiple market crashes over 14 years, and consistently selects quality companies, well, why not just liquidate everything and go all in on SCHD? The main consideration is opportunity cost during growth periods. Dividend-focused investing can underperform growth strategies when growth stocks are favored. Companies focused on returning capital may be more conservative than companies reinvesting everything for expansion. Dividend sustainability can change during economic disruptions, and even traditional dividend champions may face challenges. There are periods when dividend investing falls out of favor, and SCHD may temporarily lag. We're seeing this in 2025, where tech indexes have dramatically outperformed dividend strategies. How SCHD perfectly fits your three-fund portfolio strategy. SCHD fits perfectly in the three-fund portfolio as a versatile hybrid. Traditional three-fund portfolios have foundational diversification, S&P 500, stability and value, and growth potential. SCHD spans multiple categories: high-quality large caps for foundation, dividend-paying value companies for defense, and solid appreciation potential for growth. I integrate SCHD using two approaches. First, enhanced four-fund approach. 25% foundational S&P 500, 25% SCHD for income, 25% pure value, 25% pure growth. Second, integrated hybrid approach. My preference, treating SCHD as foundational or value hybrid. From 40% foundational, 30% value, 30% growth, I'd modify to 25% foundational, 35% SCHD, 10% pure value, 30% growth. My personal 2025 SCHD investment implementation. For 2025, I use SCHD in both taxable and tax-advantaged accounts. In taxable accounts, qualified dividends get favorable tax treatment. In Roth IRAs, dividend growth compounds tax-free over decades. My current allocation, 30% foundational S&P 500, 30% SCHD, 25% growth ETFs, 15% international. Dollar cost average into SCHD monthly regardless of price, believing quality dividend companies will be worth significantly more in 10 to 20 years. Remember to keep investing profitably. This content is for educational purposes only and is not financial advice. Always consult with a qualified financial advisor before making investment decisions. Past performance does not guarantee future results. Please like, share, and subscribe. Here's to your investing success. Profitable investing.